There's a financial price you've been paying your entire life and no one ever told you. Not because you signed a contract, not because you made a bad decision, but because the system quietly built the bill long before you ever touched money. And yes, whether you notice it or not, that bill shows up in ways that hit your wallet, your opportunities, and your future. Welcome back to Virtual Finance Navigator, where we talk about the kind of money truths you won't hear at the bank, in school, or in those motivational videos that pretend buying a latte is the reason people aren't wealthy. Today, we're diving into something far more real, far more complex, and far more important: the financial realities that shape the lives of millions without their permission. Here's the part many people never question. Why do two people work the same job, earn the same salary, follow the same steps, yet end up in completely different financial realities? Why do some families build wealth effortlessly, while others hustle for decades just to break even? Why does it feel like certain financial doors were locked long before you even knew they existed? The answer isn't one thing, it's layers. Layers of history, policy, pricing, access, expectations, and unspoken responsibilities that shape money outcomes long before the paycheck arrives. And today we're peeling back those layers one by one. So if you're ready for a breakdown that's honest, eye-opening, and just the right amount of uncomfortable, kindly like, subscribe, and let's navigate this truth together. Number 1. The wealth gap. How the start line was set. The wealth gap isn't just a financial difference, it's a difference in starting lines. Some families begin the race with brand new running shoes, a personal trainer, and a bottle of electrolytes. Others are asked to sprint barefoot on gravel while carrying a backpack full of history, and somehow everyone is expected to reach the finish line at the same time. Makes perfect sense, right? To understand the hidden cost of being black in America, you have to start with the wealth gap, not income, but wealth. Because wealth is what buys homes, launches businesses, pays for education, covers emergencies, and gets passed down to the next generation. It's the financial safety net that makes life less chaotic. Here's the reality. The average white family in America has 6 to 8 times more wealth than the average black family, not double, not triple, up to 8 times. And that gap hasn't magically shrunk with time. In some areas, it's widening. This isn't the result of different work ethic or ambition. It's the legacy of policies and systems that built wealth for one group and blocked it for another. For decades, Black Americans were excluded from the easiest, fastest pathways to wealth. Home ownership, restricted; access to business loans, denied; fair wages, optional; opportunities, limited. Meanwhile, other families were accumulating assets, tapping into rising home values, getting low-interest loans, and passing down wealth like heirlooms. Wealth is like compound interest. The earlier you start, the easier it grows. And the opposite is also true. The later you start, the harder you have to work just to catch up. Many black families weren't simply late to wealth. They were actively prevented from entering the game. The lack of inherited wealth is one of the biggest hidden costs. While some people receive help with down payments, college tuition, emergency bills, or business funding, many Black Americans become the emergency fund for their family. Instead of receiving generational wealth, they send support backward, slowing their own financial progress. This starting line disadvantage isn't about blame, it's about understanding the terrain. Because if the race was built unevenly, winning it requires strategy, awareness, and tools previous generations never had access to. And that's exactly why breaking down these hidden costs matters. Number 2, the black tax, the financial weight. No one talks about. The black tax isn't printed on any official document, but it shows up more consistently than most bills. It's not a government charge or a fee at checkout. It's the unspoken financial responsibility many Black Americans inherit the moment they become the one who made it, or at least the one doing slightly better than last month. While other families may pass down wealth, properties, stocks, or trust funds, many Black families pass down responsibility, and responsibility isn't cheap. The black tax often starts early, helping siblings with school costs, contributing to household expenses as a teenager, paying for emergencies that wouldn't be emergencies in households with generational wealth, and later supporting parents, grandparents, cousins, nieces, nephews, and that one relative who always needs a little something until Friday. This isn't about lack of discipline, it's about the financial reality created when multiple generations were denied access to wealth-building tools. If a family couldn't accumulate assets in the past, they naturally turn to the one person who seems to be progressing now. And when someone becomes the financial anchor of the family, their ability to build personal wealth slows down significantly. Economists call this a reverse transfer of wealth. In other communities, wealth transfers downward, parents paying for college, helping with home down payments, offering business capital. In many Black families, wealth transfers upward and sideways, the younger supporting the older, the slightly stable supporting the unstable. And those transfers add up. The hidden cost? Every dollar spent supporting the family is a dollar that cannot be invested, saved, used for a down payment, or put toward retiring early. Over a lifetime, that cost can reach six figures, yet it's rarely discussed. Now, let's be clear, supporting family is an act of love, honor, and culture. It's part of what makes Black communities strong, connected, and resilient. But it becomes a financial trap when one person becomes responsible for lifting everyone up while still trying to climb themselves. The Black tax isn't about guilt, it's about awareness. Because you cannot build a strategy if you don't understand the obstacles. Once you name the weight, you can begin learning how to carry it smarter instead of harder. And there's another hidden cost that's just as powerful, one tied to where you live and how that location shapes everything from schooling to wealth-building opportunities. Number 3, housing inequality and home appraisal bias. Housing is supposed to be the great wealth builder, the foundation of the American dream. Buy a home, watch it grow in value, build equity, pass it on. Simple, right? Well, simple for some. For others, the dream came with fine print that mysteriously wasn't included in the brochure. For decades, Black homebuyers were strategically kept out of neighborhoods that would later explode in value. Entire communities watched the wealth boom from the sidelines while other groups rode the appreciation wave all the way to generational prosperity. Meanwhile, Black neighborhoods were redlined, starved of investment, and treated as risks before a single resident even applied for a loan. And the effects didn't disappear, they simply evolved. Today, appraisal bias continues the legacy in a modern outfit. Studies show Black homeowners often receive lower home valuations compared to similar homes in majority white areas. In some cases, families saw their home value increase by hundreds of thousands of dollars simply by removing family photos, Black art, or cultural decorations before the second appraisal. Yes, you heard that correctly. Hiding cultural identity can sometimes raise the value of your house. Nothing says equity like pretending you don't exist. Lower appraisals mean less equity, less borrowing power, lower resale value, and fewer opportunities to leverage home ownership for business, education, or future investments. It's like playing a game where you do everything right, buy the house, maintain it, upgrade it, but the scoreboard refuses to update for you. And then there's neighborhood investment. Many majority Black communities receive fewer resources, weaker school funding, lower infrastructure investment, fewer grocery stores, fewer banks, more predatory financial services, all of which affect home values directly and indirectly. A neighborhood's worth is tied to more than houses. It's tied to how society chooses to value the people living there. Now some might say, well, just move to a different neighborhood. As if home ownership were a simple checkout process. Add to cart, enter address, select shipping option. No, housing access is shaped by income requirements, loan approvals, market competition, credit standards, and yes, subtle gatekeeping that still finds its way into the process. The hidden cost of being Black in America isn't just in buying a home, it's in trying to grow wealth through a system that often undervalues your effort before you even start. And speaking of undervaluing, the next hidden cost sneaks into every financial product you touch. Number 4, credit inequality, and higher interest penalties. Credit scores were marketed as the great equalizer, a clean, objective, numbers-only system designed to reward responsibility. In theory, two people with the same score should receive the same interest rates, right? In theory, yes. In America, that's adorable. In practice, Black borrowers often pay more for credit even when they have similar or identical credit profiles to their white counterparts. Higher interest rates on mortgages, car loans, credit cards, you name it. It's like shopping at a store where the price tag changes depending on who walks in, and somehow you're always getting the limited edition markup. But let's talk about how credit inequality forms in the first place. Black Americans are statistically more likely to grow up in households with fewer financial resources. That means fewer opportunities to build early credit, fewer safety nets to avoid missed payments, fewer chances to become authorized users on parents' cards, and more exposure to predatory lenders targeting neighborhoods that banks conveniently skipped. When you start late, the system charges you for playing catch-up. Add in inconsistent access to mainstream banking services, higher overdraft fees, and lower approval rates for prime credit products, and the score becomes less a reflection of financial responsibility and more a reflection of historical roadblocks. Credit scores don't just calculate debt, they calculate risk. But when a system has historically labeled your community as risky, guess what travels into the algorithms built decades later? You guessed it, the bias doesn't vanish just because the font is digital. And the cost of a slightly higher interest rate, massive. A Black borrower can pay tens of thousands more over the lifetime of a mortgage simply because they were offered a slightly worse rate. The same applies to auto loans. The same applies to personal loans. Over time, the small additional penalty snowballs into real lost wealth. Meanwhile, financial institutions proudly advertise fairness and equality, sprinkling diversity photos in their brochures like seasoning, while charging certain communities the financial equivalent of a processing fee for existing. Credit inequality isn't just a cost, it's a multiplier of every other cost. If your housing is undervalued, if you start with less wealth, and then you're charged more for borrowing money, the gap widens from unfair to mathematically impossible. But credit is only one part of the story. There's another hidden cost baked into the income side, one that shows up every payday. Number 5, employment gaps and unequal pay structures. Employment is supposed to be straightforward. You work, you get paid, and if you work harder, you get paid more. A beautifully simple concept, almost poetic, really. Unfortunately, simplicity isn't America's strong suit when it comes to Black workers. Instead, the job market comes with its own set of hidden settings that mysteriously activate depending on your background. Let's start with wages. Black employees, on average, earn significantly less than white employees doing the exact same job. Not similar, not comparable, but literally the same work. Studies show that even when education, experience, and job title are identical, the pay gap persists. It's as if the paycheck calculator pauses, glances around suspiciously, and says, let's adjust that number a bit. And then there's the hiring process, a game of chance with odds that lean heavily in one direction. Resumes with ethnic-sounding names receive fewer callbacks, even when qualifications are identical. So before a job seeker even steps through the door, their chances are already being quietly trimmed. Let's talk about career advancement. Many Black professionals face slower promotion rates and fewer leadership opportunities, despite outperforming peers. This isn't due to lack of talent, it's the result of workplace cultures shaped by decades of internal networks, favoritism, and unconscious biases that push certain candidates to the back of the line. It's hard to climb the ladder when someone keeps moving the bottom rung. And then there's occupational segregation, the tendency for Black workers to be clustered into lower-paying roles and industries. Whether intentional or structural, the result is the same: limited income, fewer benefits, and reduced long-term wealth. When entire communities are pushed into jobs that don't offer retirement plans, paid leave, or advancement opportunities, The financial impact ripples for decades. Even unemployment hits differently. During economic downturns, Black unemployment rates rise faster and stay higher longer. It's like having a storm hit your neighborhood harder every time it rains, not because of bad luck, but because the system's drainage was never built properly. The cost of unequal employment is enormous. Lower lifetime earnings mean smaller savings, less investment potential, reduced home buying power, and fewer resources to pass down. And when your income is already undercut by inequality, every other financial barrier becomes heavier. But if you think employment inequality is costly, wait until we talk about the price of borrowing money in a system that has historically treated Black applicants like walking red flags. Section 6. Loan discrimination and predatory lending. If borrowing money were a simple process, this section wouldn't exist. But here we are because the lending system has a long and impressive history of treating Black applicants like financial liabilities before even checking the paperwork. And when a system starts the conversation with, "No, but let's pretend to review your application anyway," you already know how the rest of the story goes. Loan discrimination has been documented for decades, and the numbers haven't magically corrected themselves. Black borrowers are more likely to be denied mortgages, even when they earn the same income, carry the same debt, and have similar credit profiles as white applicants. That's right, identical financial stats, different outcomes. Apparently, the calculators have trust issues, and when Black borrowers are approved, they're often steered toward loans with higher interest rates, additional fees, or subprime terms, which is ironic because these products were supposedly created for high-risk borrowers. Yet the definition of risk seems suspiciously flexible. Let's not forget the role of predatory lenders. These friendly neighborhood businesses specialize in offering quick cash with interest rates high enough to make your eyebrows rise. Payday loans, rent-to-own stores, check-cashing outlets. They don't just appear in certain communities by accident. They're strategically placed like fast food chains on every corner, convenient, accessible, and financially disastrous. The result? Black families end up paying more for basic financial services that other communities get at normal cost. A subprime mortgage can drain tens of thousands in extra interest. Payday loans can turn a $300 emergency into a months-long financial hostage situation. Rent-to-own furniture becomes a luxury debt trap disguised as a good deal. Even small differences matter. A slightly higher interest rate on a car loan means less money for savings. A mortgage denial means renting longer, which slows wealth building. A predatory loan means financial recovery takes months instead of days. And let's be honest, lenders advertising second chance financing often function more like first step to financial ruin companies. But when mainstream institutions deny access, people turn to whoever says yes. The problem is that the yes is often the most expensive word in their entire financial life. Loan discrimination doesn't just block wealth, it extracts wealth. It's a silent siphon, draining financial potential 1 percentage point at a time. But the hidden cost of being Black in America goes beyond numbers and interest rates. Some costs are invisible, passed down through generations, not as debt, but as lack of knowledge and access. Number 7. Lack of financial exposure, mentorship, and networks. Financial success isn't just about money, it's about exposure. The kind of exposure that lets you know what's possible, what's normal, and what plays even exist in the financial playbook. And that's where one of the biggest hidden costs emerges: the lack of early access to financial knowledge, mentorship, and networks. Let's start with the obvious truth. You can't copy a blueprint you've never seen. Many Black Americans grow up without direct examples of generational wealth, real estate ownership, investing, business inheritance, or someone casually explaining how tax write-offs magically make rich people pay less. Meanwhile, in other households, these conversations occur between bites of dinner. This lack of exposure isn't about intelligence, it's about access. Access to someone who can explain why credit is more important than cash in certain situations, or how a Roth IRA works, or why owning assets is more powerful than earning a bigger paycheck. When financial knowledge is not inherited, it has to be learned the long, expensive way through trial, error, and the occasional, "I really wish someone told me this sooner" meltdown. Then comes mentorship. In many industries, career advancement depends less on talent and more on who sends your resume to the right inbox. But without mentors in high-earning fields or leadership positions, Black professionals often miss out on opportunities simply because no one in the room knows their name yet. Talent gets you in the door, networks decide whether the door opens. And let's talk about business networks. Many successful entrepreneurs were born into circles where someone could offer seed funding, introduce investors, or explain how to scale without burning through savings. But when you're a first-generation entrepreneur, you're often building the business, learning the laws, fixing the mistakes, and Googling how to avoid IRS trouble at 2 a.m. all at the same time. Lack of exposure also leads to delayed financial milestones. While others buy homes in their 20s or invest early, many Black adults spend their early financial years simply trying to understand the system, repair credit issues they inherited, or support family members financially. The hidden cost. Time, the most valuable currency. When you start learning money principles at 30 instead of 15, the compounding power of wealth shrinks dramatically. But exposure and networks aren't the only hidden costs. There's another one, something far more personal, internal, and psychologically complex. Number 8. Psychological and emotional cost, financial behaviors. Money is emotional. Anyone who says otherwise has clearly never checked their bank account after an "I deserve this" weekend. But for many Black Americans, financial behaviors aren't shaped just by choice. They're shaped by history, survival, and generational stress that rewires how money feels long before it ever hits the wallet. Let's talk about the scarcity mindset, a psychological condition created when people consistently experience lack of money, lack of stability, lack of safety nets. When scarcity becomes normal, the brain learns to prioritize immediate needs over long-term planning. This is why someone might buy something now instead of saving for later. Later has not always been guaranteed. Scarcity doesn't just affect spending, it affects risk-taking. Investing feels dangerous when you've been taught, directly or indirectly, that mistakes have consequences your safety net cannot fix. Meanwhile, people with generational wealth treat investing like a fun hobby. "Oh, the market dipped? I'll just buy more." Must be nice. And then there's financial fatigue, the exhaustion that comes from constantly stretching resources, solving emergencies, and being the dependable one in a family with limited economic support. When you're emotionally drained, the last thing you want to do is watch a 45-minute video explaining ETFs. Sometimes you just want comfort, convenience, and a moment of peace, even if it costs more. Let's not forget representation fatigue. In many workplaces or industries, being the only one adds pressure to perform perfectly, avoid mistakes, and prove worthiness. That pressure spills over into financial decisions, choosing safer career paths, avoiding riskier ventures, or delaying dreams because the margin for error feels too thin. Then comes aspirational spending, a coping mechanism born from years of being told you don't belong in certain spaces. Sometimes buying nice things isn't about showing off. It's about reclaiming dignity in a world that undervalues you. But aspirational spending becomes costly when it replaces wealth building with momentary relief. And there's the emotional cost of constantly hearing messages like, "Black people don't," or "we can't." That kind of generational conditioning subtly shapes beliefs about what is possible. Money decisions aren't just math, they're mental programming. The hidden cost here isn't dollars, it's mindset. Because money can only grow where belief, exposure, and emotional stability exist. But awareness is the first step. And once we understand how psychology shapes financial behavior, we can begin rewriting the script. Now let's move to the final piece, the path forward. Number 9. The road to breaking the cycle. Clear, actionable steps. The hidden costs are real, heavy, and deeply rooted, but they're not unbeatable. Generations before us navigated systems designed to limit their progress, and still they created culture, built families, and opened doors that didn't even exist before. So imagine what becomes possible when we combine that same resilience with modern financial knowledge, digital tools, and collective strategy. Now we're talking about transformation. Breaking the cycle starts with financial literacy, but not the boring kind, the practical kind. Understanding credit, debt, interest, taxes, and investing isn't a luxury, it's survival training. When you know the rules of the game, you stop playing defense and start making strategic moves. Next is leveraging ownership, real estate, businesses, stocks. These are the engines of wealth. They don't require you to work harder, they require you to work smarter. Even small, consistent investments can outperform decades of extra labor. Ownership democratizes wealth in a way income never will. Then there's community strategy. Instead of each person trying to climb the financial mountain alone, families can coordinate. One person buys a home and rents to relatives, another becomes the family credit expert, another learns investing. Wealth becomes a team sport, not a solo performance. We also need financial boundaries, the respectful kind. Supporting family is honorable, but carrying everyone financially is unsustainable. There's a difference between helping and self-sabotage. Boundaries allow you to grow your wealth so you can help more effectively later. Mentorship matters too. Whether it's a boss, an online coach, a business group, or a friend who happens to know how Roth IRAs work, bless them. Exposure accelerates success. You don't need 1,000 mentors, you need one person who's been where you're going. Finally, there's mindset shifting. Moving from survival mode to strategy mode takes time, but it's powerful. When you see money as a tool instead of a threat, you stop fearing it and start controlling it. And that shift, more than any policy or statistic, is what turns generational struggle into generational strength. Breaking the cycle isn't about perfection. It's about awareness, intention, and consistent forward steps. Thank you for watching this financial breakdown of the hidden costs shaping the economic reality of Black America. We've explored the wealth gap, the black tax, appraisal bias, credit penalties, wage inequalities, predatory lending, lack of exposure, and the psychological burdens that influence financial behavior. None of these are isolated. They connect, compound, and create gaps that aren't just historical but current. But here's the most important takeaway. Awareness creates power, and power creates change. You now understand the forces at play and, more importantly, how to navigate them, challenge them, and rise above them. Your financial future doesn't have to match the past. You have the tools, the knowledge, and the clarity to rewrite your economic story. If this video inspired you, enlightened you, or made you think deeper about the financial journey ahead, kindly like, subscribe, and turn on notifications. Tell us in the comments, which hidden cost surprised you the most? This is Virtual Finance Navigator, guiding you towards smarter money decisions, one truth at a time.